everyone. Welcome to Economic Impact. Today is November 20th, 2024, and as usual, I am with our chief economist, Stéphane Marion. Stéphane, we had an election in the United States.
Yeah, it's been a shock for many people, many sectors, but for financial markets, Denis, I have to tell you, it's been positive so far. And as you look at the year so far, year to date, we're looking at positive returns for every asset class. And you know what? Despite the fact that the stock market has done particularly well this year in the U.S., Canada too, and last year, investors now believe that next year could be yet another banner year.
Wow. Can we say the same thing for across the world? Is it the same situation? Are we seeing the same results?
No, breadth is not that great, Denis, when you think about it, because the reality is that there's a lot of numbers on this slide, but bear with me. Like, if it's green, if it's green, these markets reached a new all-time high in November. There's only 3 markets in the world that did that: the U.S., Canada, and Hungary. So not everyone wins in this new political or geopolitical environment.
And since the election of Mr. Trump, price earnings are still at the top, at the highest.
Well, the reason the U.S. is as high as it is right now, it's been driven by multiple expansions. So forward P/E ratios are now trading at 23 times forward earnings. Denis, if you look prior to the COVID pandemic, when earnings normally surge during a recession, you have to go back to 1999 to see earnings or price, the valuation on the stock market as high as what we have right now. And notice that the valuation on the U.S. stock market is 35% higher than it was when Mr. Trump first won his election in 2016. So there's a lot of good growth expectations already built in the current valuations.
And at the same time, we're observing shift in the yield curve, major shift in the yield curve.
This is where I'll need you to help me, because you used to be a fixed income specialist, and you still are, but you are actively involved in terms of trading. So what we're seeing right now, what's helping fuel the rally in financial markets is the fact that the yield curve, which had been inverted for 2 years, and remember, you and I exchange a lot of times on that, saying an inverted yield curve is not a good sign for the economy. Well, guess what? The inversion has disappeared, and now people are saying, wow, if the yield curve inversion has disappeared, therefore the economy can only do better in the months ahead.
Yeah, what's quite interesting that we're seeing a yield curve, shifting upward, but we're seeing rates going down. And down, we don't see that very often in the cycle.
No, so it's a yield curve, it's a steepening, but it's a bear steepener, and that, Denis,
that's getting complicated.
It's complicated, but it's most important, because if you calibrate your model on just the shape of the yield curve, you say, okay, it's steepening, it's good for the economy, is one thing. But what's happening right now, it's steepening, but I can't calibrate a model for something I've never seen. So what I'm trying to say here is that, yes, rates are coming down at the short end of the curve. The Fed's already reduced the Fed funds rate by 75 basis points, but long-term rates, 10-year Treasury yields are up 79 basis points. So this type of bear steepener, Denis, has not been observed in over 30 years. Since the Fed started targeting the Fed funds rate, this is the first time it happens when the Fed starts cutting rates. So most unusual.
But what's kind of weird also is that the U.S. government are going for, probably one of the biggest deficits ever. And we're seeing yield curve going down, in fact, shifting up, and Treasury's Fed fund going down.
So
that's weird.
There's a malaise here that seems to be explained by the fact that the 10-year Treasury yield is moving higher because people are concerned now because with the level of government debt in the U.S. So unless the U.S. is able to significantly reduce its spending, what we're looking at for the next few years is that the U.S. debt to GDP ratio will exceed the previous high, which was reached after, at the end of World War II, when the U.S. was financing a global war. So we are in uncharted territory, hence the movement of the yield curve that is most uncanny.
Despite all of that, PI are high, yield curve is shifting up, Fed funds are going down, people are still expecting good results or good performance for the coming years.
So people are looking at the yield curve with not necessarily the same amount of details that we should speak to. Is it a bear or a bull steepener? So you're absolutely right. What's driving the market right now? It's a steepening in the yield curve, as simple as that. And yes, every region of the world is expected to benefit from the new economic policies that will be unveiled by Washington in the quarters ahead. So anyway, Denis, when you look at this, every region of the world is expected to be up next year. So I'm not sure everyone wins in a new political or geopolitical environment, but these are the expectations as we speak.
There's a lot of positivism on the market right now.
There's a lot of good news already priced.
A lot of good news
yes.
that are already priced in the market.
But the bond market is getting a little bit more suspicious.
Okay, let's come back to Canada and talk about what's going on in our own country in terms of unemployment.
So I'm going to tell you why we have a weak currency, right? So the reality is we have a big divergence in terms of economic performance with the unemployment rate for people aged 25 to 54, which is your biggest consumer base, if you want, at over 5.5% in Canada, whereas in the US it's at closer to 3.5%. So this massive divergence, Denis, brings that if the economy is not performing, obviously monetary policy can diverge between the two countries.
Yeah, that's mean that lower Canadian rate, but lower Canadian dollar.
So the way your forecast models work when you do your currency forecasts, if you have an historical, it's a near historical spread, well, I won't say historical, but the highest since 1997, this divergence between monetary policy between the two countries is likely to be sustained for longer because of the behavior of the unemployment rate, which brings about a cheaper currency. So we're at 141 to buy a US dollar. Well, we might have to pay 145 in the months ahead, according to our model, if those interest rate differentials prevail for a little bit longer, which I believe they will just because of where the economy is relative to the US. So a lot of moving parts, Denis.
Well, you have a lot to say today. Okay, what kind of conclusion we can come with?
Well, the conclusion is it's even difficult to know precisely with precision where you are in the cycle because the US keeps on pushing more fiscal stimulus despite the fact that the unemployment rate is low. And with the yield curve that is starting to steepen right now in bear steeper mode, we will see what happens in the months ahead, particularly that the stock market is not cheap in the US. So if long-term rates move higher because people are concerned about fiscal policy, that might be an issue. Denis, I would also say, not everyone will win in the new economic regime, but the market seems to be positioned that everyone wins. So I'm a little bit more skeptical on that one. I know that there's a lot of hype that AI could boost productivity, and that's fine by me. I have no issues with that, but down the road, you have to be consistent with economic theory. If I want to do more AI, more robotics, I need more electricity, and electricity costs are becoming a concern at this point in time. So by and large, Denis, it's a structural change. This election will bring about structural change. Deregulation, tax cuts will be good for corporate earnings, but there are other concerns, particularly what happens with the steepening of the yield curve. So the message here today, let's just be prepared to live with markets fluctuation in the months ahead. There will be volatility. The market will find a direction, but I'm not sure that it's a one-way bet that everything goes up next year.
And once again, let's be careful.
Absolutely.
Well, thank you, Stéphane, for being with us today. Hopefully, it's going to help you in your investment, assets and everything, portfolio management. We'll see you in December. Thank you for being with us.